Now we're going to talk about theories of monetary unions and macroeconomic policy. So according to the normative theory of optimal currency area, independent states form a currency union if they share strong economic ties. Such countries can benefit from adopting a common currency if this is likely to foster closer integration of the capital markets and facilitate trade. This must be weighted against the loss of the ability of the to use the central bank interest rate and exchange rate as macroeconomic policy tools. There are four main criteria for an optimal currency area. First, ease of labor mobility sufficient to ensure that the unemployed in one state should easily be able to take up work in another state in the currency area. Second, capital mobility and wage flexibility is sufficient to allow employees in states with low demand to adjust their salary in order to attract capital from high demand states. Third, similar business cycles such that economic booms and recessions are shared so that the central bank can effectively pursue a common monetary policy to smooth over the economic cycle and control inflation. Fourth, there must be a common risk-sharing system across the state to support states and regions that suffer from economic difficulties. So in this framework, a state facing an economic downturn should compare the political, social and economic costs of pursuing one of the two following strategies: to devaluate its currency or to combine stable exchange rate arrangement with wage reduction and labor mobility. Only if the second strategy is less costly than the first should a country join a currency area. Well, this seems like a straightforward test. The assessment of the cost associated with both alternatives is contested. Starting with the cost of foregoing devaluation and interest rate adjustment as a policy tool, here the key issue is whether the central bank is able to generate growth by lowering its interest rate or devaluating the currency. In the traditional Keynesian view, prices are rigid. So devaluation can improve the competitiveness of the economy as exported goods become cheaper at the international market and imported goods become more expensive, and this helps the domestic market-oriented producers to become more competitive. Also, according to this tradition in economic theory, the government can generate surprise growth by lowering the interest rate and thereby increasing the availability of money. In this perspective, the central bank can trade off inflation against employment. Higher inflation is expected to translate into more jobs. The job of the central bank is to balance inflation against job creation. In this perspective, the ability to adjust the interest rate and the exchange rate are valuable tools as they are essential for the proper management of the economy. Now, the real business cycle theories challenge the above evaluation of devaluation and interest rate adjustment as useful macroeconomic tools. To them, it is the real, not the nominal, level of prices that matter. Short-term fluctuations in the prices of money are unlikely to have a major impact on the real economy. Moreover, devaluation and interest rate changes are rather blunt instruments. It is unlikely that central bankers will be able to fine-tune them to the development of the economy at any given time. So if the central bank had such capacities, it is likely that other actors would be able to factor in the probability of devaluation and surprise inflation, and thereby decreasing the effectiveness of such policies. So the central bank should not concern itself with the final adjustment of the unemployment inflation curve. Instead, it should commit itself to a policy of price stability, so that it is easier for the actors to hold accurate expectation of future nominal prices. For a proponent of this view of monetary policy, the effectiveness of currency and interest rate manipulation as a policy tool is low. Moreover, as the focus is on the real, not the nominal prices, the cost of price adjustments is also lower than in the Keynesian perspective. The question then becomes to what extent the participants in the monetary union are willing to pay the potential political cost of implementing any labor reform required to complete a common market and adjust prices accordingly, thereby facilitating labor and capital mobility, or implementing redistributive policies to support the regions that experience economic difficulties. This is much more political than an economic question. The essence in the monetary system is trust. The political logic of banking is as follows. The core of bank business is loans. The depositors lend the banks their money in the expectation that it will be returned, and banks lend money to creditors in the expectation that creditors will repay the loan. Banks depend on government institutions for maintaining the trust, as the state institution can be relied upon for reclaiming assets. Governments can, in return, require that banks set aside a proportion of the asset to ensure their liquidity. Moreover, the powers of the government can be used to extract concessions from the bank. Hence, investors would need a risk premium on their investment in order to be willing to invest in the banking sector. Such premiums can come in the form of entry restrictions or other regulations that allow bankers to extract a higher premium than they would be able to do under perfect market conditions. Moreover, governments have incentive to design banking regulation to benefit their political supporters. Also, bank depositors are unlikely to re-elect government that fail to act to secure the deposit when at risk, and government will act if banks are unable to repay a deposit on demand. This in turn allows banks to take bigger risk when lending out the deposits. So when governments act to save banks, taxpayers are typically footed the bill. As individual taxpayers may be depositors as well as creditors and bank investors, it is difficult to evaluate the net effect of bank interventions during a banking crisis. Moreover, as pointed out by Olsen, diffuse groups such as taxpayers have a hard time organizing against concentrated interests such as banks and institutional investors. So while a functioning banking system is a public good and essential for the proper functioning of a modern economy, the design of banking regulation benefits the banking sector and the government coalition to a larger extent than diffuse groups such as taxpayers and the general public. However, the financial sector is, as many other sectors, heterogeneous, with variation both geographically and across types of financial institutions. It may thus be misleading to think that the financial sector acts as a unitary actor capable of promoting only one single interest.